You see a rather more moderate, sensible view, I think, in my opinion, of crypto from Aswath Damodaran. So first, we're going to see Warren Buffett. It's about just a little under 3 minutes, and then a couple of minutes with Damodaran. Let me make sure before I go too far, if you would just kind of give me a thumbs up if the sound is coming through. I just want to make sure that's...
You said, did Justin Sun change your
You
mind
hearing
on
sound?
crypto?
Cool. All right. So here goes.
Currencies. For anybody who doesn't know, Justin Sun bought the dinner or the lunch that you just had from the last Glide Foundation fundraiser. He is actively involved in Bitcoin. After that meeting, his PR people put out some notes saying that, you know, you kind of listen to cryptocurrency and maybe you're a little more in tune with the idea of Bitcoin now.
So I would say this, when Justin and 4 friends came, they behaved perfectly.
My bad.
And we had a good 3.5 hour
Sit
dinner,
back.
and the whole thing was a very friendly exchange of ideas. But cryptocurrencies basically have no value, and they don't produce anything. So you can look at your little ledger item for the next 20 years, and it says you've got X of this cryptocurrency or that. It doesn't reproduce. It doesn't deliver. It can't mail you a check. It can't do anything. And what you hope is that somebody else comes along and pays you more money for it later on. But then that person's got the problem. But in terms of value, zero.
So it sounds like he did not change your position.
No, but I didn't change his either. And I had a very
obviously this is a little old. That Bitcoin was only at 9,700.
Justin gave $4.6 million to Glide, and that will buy a lot of meals and provide a lot of beds for people in San Francisco. So I thank him.
He gave you some Bitcoin. What's it feel like to be a Bitcoiner?
I don't have any Bitcoin.
You don't?
No.
Okay.
No.
You don't own Bitcoin?
No, I do not own one. I don't own any cryptocurrency. I never will. And, in the end, I may start a Warren currency. Maybe I can create one, and I'll say there's only going to be 21 million of them, and you can have a little ledger sheet from me and everything that says you have it. And you can have it after I die, but you can't do anything with it except sell it to somebody else. And the interesting thing, of course, is that Bitcoin's been out there a long time, and people talked about how it would be used in various kinds of exchange, but none of our companies are doing business in Bitcoin or anything. Bitcoin has been used, I think, to move around a fair amount of money illegally. So the people
or maybe in countries where you have
the logical move from the introduction of Bitcoin is to go short suitcases, because the money that was taken in suitcases from one country to another, suitcases will probably fall off in demand. I mean, so you can look at that as the economic contribution of Bitcoin to the society.
All right, so that's Warren Buffett's take on it. Now, let's go to Aswath Damodaran, who, and again, I've listened to these in the past. I did not set up my headphones. For some reason, I have to actually have a splitter here, and I didn't set that up for this particular thing, so I'm going to have to go off of memory. But I don't think the Aswath talks more about, while you can't necessarily value crypto, just like Buffett says, he doesn't think that the entire blockchain sector is not worth owning. In fact, he makes some pretty sound arguments for owning a piece of this. So here's Aswath Damodaran.
Is Warren Buffett right on crypto?
I think he's brushing the entire sector with too broad a brush, because I don't think you can write off cryptocurrencies altogether. Is it going to end badly for some of the people involved? Absolutely. It's going to end badly for those people who got under the bandwagon late and are playing the pricing game. That's all they're doing. They're hoping to buy at a low price and sell at a high price. And for some of them, it's going to end badly. But looking forward, I agree with your panel that there is a future for fintech. And I think we mix together lots of different kinds of crypto investments in the cryptocurrency space. Some of them are going to succeed. Some of them are going to not. So I think to put them all together in one big bucket and throw them over the edge doesn't make any sense to me.
Is that why you think you can value Ethereum versus Bitcoin?
Yeah. In fact, when I look at the cryptocurrency buckets, I see three separate buckets. There's the cryptocurrencies like Bitcoin, which cannot be valued because they're currencies. They're crypto commodities. Ethereum is a crypto commodity. What's different about Ethereum is it's not marketed as a currency. It's marketed as a lubricant for smart contracts. And smart contracts are what the fintech, the blockchain revolution is going to deliver. And if Ethereum can become a significant part of that business, you can value it as a commodity. And there are crypto assets, which are what the ICOs are, which can be valued as slices of businesses. So I think to view them all as useless and worthless is, I think, wrong.
It's Karen, let me ask you something. In the original, I guess, internet bubble, 2000, did you find that you had the same ideas about difficulty of valuation, and or there were other metrics that got you comfortable then?
You know what? I love valuing difficult to value companies. It makes me strange. I get them wrong
why
every
he's the
single
dean
time.
of
but I-
valuation.
That's what you got to do.
So I've valued Amazon every year since '97. I've bought Amazon 4 times. I've sold Amazon 4 times. I didn't buy it at the right time. I didn't sell it at the right time. But to me, there is a way to value these companies. You cannot walk away saying, I don't understand a business, so I cannot value it. Because the older you get, the more of the world you're not going to understand. So if you take the Buffett view, most of the world is going to start to be off, out of bounds for you. So I think we've got to try to value businesses, even if they're young, even if they're in places where everything is evolving, everything is changing.
So I want to get back to Ethereum, since you think that we can evaluate or value Ethereum. How is it valued right now relative to how it's trading?
I'll be quite honest. I think every single crypto asset is being priced right now. It's not being valued. What I mean by that is if you ask people why they're paying what they are for any of these crypto investments, you don't get a fundamental answer. You don't get a logical answer. You get an answer of, I think I can make more money on this. So I don't think any of these investments are being valued right now. They're being priced, but that's not unusual either. You could say the same thing about the dot-com sector in the late 90s, is every company was priced. Eventually, valuations matter. And that eventually might be a year from now, 2 years from now. And maybe that's what Buffett is talking about when he talks about a bad end, is when that valuation time comes, some of these crypto investments are not going to hold up. So right now, I don't think anybody's valuing a crypto investment. They're all pricing it.
Okay, they're priced, but how do you value it? Or have you put a valuation on it so we can gauge what the disparity is?
I'll tell you what's holding me back. I don't see a business model yet from Ethereum. They're talking the talk, but they're not walking the walk yet. They're talking about how they're lubricants in the smart contracting business, but they're not being lucid about the way they plan to make money on that business. So I can't get ahead of them and create a business model for them. That's not my job. So until they create a business model, I'm kind of holding back. But I think that that's going to be the next phase in the crypto investment market, is you're going to start to see people pushing these crypto investments to come up with business models to show how they will make money. But that's part of the life cycle of investments as well.
Hey, Dean, it's Brian Kelly. So I'm curious about that, because Ethereum is an open source project. It's not a company, so they're not going to put forth a business model necessary. And part of their value or their value prop is that they are the picks and shovels. You can build on top of this. Isn't that the business model?
But eventually the picks and shovels have to get pennies on the dollar, or cents on the dollar, because without it, the picks and the shovels are worth nothing, right? So ultimately, even if it's an open source model, some of the revenue generated from using those picks and shovels have to accrue to Ethereum. If that doesn't happen, it's worth nothing. If that does happen, it's worth something. So the fact that it's an open source model that's giving the picks and shovels doesn't make it necessary that you will not be able to generate those cents on the dollar.
So, observations, opinions? What do y'all think about those two?
I thought it was kind of interesting how Warren Buffett just kind of like brushed off the whole thing as what was it, Dammer?
Demoderin, yeah. Mm-hmm.
Kind of said like he's painting the whole sector with too big of a brush. And I also thought it was interesting what he talked about with like pricing versus valuation.
Yeah.
And how people are buying because they think it's like gonna go up, which is, I mean, I guess kind of what you do. You always hope what you're buying is gonna go up unless you're shorting it, but I thought it was kind of an interesting distinction he made that I've never really like thought about before.
Good, good. Yeah, I agree. I think the concept, and to use the terms the way he did, the pricing versus valuation, and remember, a company like Sherwin-Williams is actually producing a product. They pay a dividend. There's reason to expect that they'll be, creating more revenue in the future. So they have this fundamental reason that we can actually try to value. We don't always succeed, and looking into the future is always fraught with difficulty. Whereas something like Bitcoin, it doesn't produce anything. Now, yeah, there is one piece of it that I don't think either of them really mentioned, and that is as a means of moving money across the globe. I think that's something that right now the system that we have, the SWIFT system that we use to move money internationally, is just horribly old, and it's about to fall apart. Takes days to move money. It's terribly expensive. Bitcoin, boom, you can do it like that. You take dollars, convert them to Bitcoin, send the Bitcoin to somebody else. They convert it back to euros or yen or whatever currency they're in, and you can do that in a matter of seconds. Whereas the Swift system and the EFT, the fund transfer, is just horribly slow, and the banks like it because they make a lot of money off of it. So that's one thing that neither of them really mentioned, that is something that Bitcoin provides, that is a value and something that could be valued. But the rest of it, yeah, I agree. I mean, basically, it's who's going to pay you something more than you bought it for, and if you get Tesla, at one point was going to accept Bitcoin, and I guess actually for a period of time they did accept Bitcoin when you bought a Tesla, but now they've changed their minds again. That couldn't have been good for Bitcoin. I didn't look at the price trace, but my guess is that when Tesla announced it was going to use Bitcoin as that you could use Bitcoin to buy Teslas, that the value of Bitcoin went up a little bit, and when they reversed that, the value of Bitcoin went down, and so things like that you really can't control, have no value per se. It's just a supply and demand thing that's going on. Other thoughts and observations? Thank you, Matthew. That was good.
I was going to say, I was really surprised that, similar to what you were just saying, Dr. Elliott, that they didn't mention the volatility that social media has on the crypto world.
Mm-hmm.
I mean, you can tweet about other companies and you'll get maybe 2 to 5% movement on a really big announcement. On crypto, it's like 20 to 50% type volatility. I mean, we're talking stock doubling or tripling in a day due to Elon Musk's up saying Doge to the moon or whatever.
Yeah, right.
Point neither of them brought up was it's crazy volatility brought on by social media.
Yeah, that's a good point. Yeah. Now, still the trouble though is can you predict any of that? I don't know, to a certain degree the SEC will pursue you if you do something like that for securities. Now, Bitcoin, because it's not quote unquote a security, it's not overseen by any governmental entity. I guess it doesn't matter. You can do whatever you want. So that's interesting. Maybe you could get a crawler out there on social media looking for various references, negative or positive, to Bitcoin, create an algo that would kind of average them together. If it's on average negative, then you short Bitcoin or you sell Bitcoin. If it's on average positive, then you buy. Somebody probably already has that. That's my guess. Yeah, cool. Good point. Thank you, Joe. Other comments or discussion?
The NYU professor had mentioned Ethereum's use in smart contracts.
Mm-hmm.
and not being familiar with that term, I'm not familiar with that term. How is that different from like a contract?
Yeah, I can give you a little bit, and I won't go much further because my knowledge is probably just that much further than yours about it. But basically, the idea behind blockchain is that you have this easily observable, extraordinarily secure means of putting transactions out to the public facing transact. So if and again, I'll use the house analogy. Title searches. I don't know. If maybe you haven't bought a house, but you've watched your parents buy a house or something. There, before you can buy a house, there has to be a title search, and that's to make sure that nobody else has a claim against that house, a claim of ownership. Well, if we had used blockchain, we could trace the transactions on a house, and that could be outward facing, completely transparent. The next buyer would input their contract, and that would also be in part of this smart contract, if you will. And it's extremely secure. It's not hackable, or at least so far it hasn't been hacked. That's always begging disaster, isn't it? But that's the idea, is that you can create these virtual contracts that are very secure, that everybody can see who's doing what. And it doesn't have to. Now, Bitcoin is anonymous, but these contracts don't have to be anonymous. They can have, your name as the seller, my name as the buyer, or vice versa, and then anybody else can look at it. At least that's anybody have a better description? Because, like I say, my amount of knowledge about blockchain is just a shade more than Luke's possibly, but some of you probably have a better handle on it. Any thoughts, comments about smart contracts? I'll have to do a little more digging, see if I can learn a bit more about it and share that with you. But I do believe, I do think that what Aswath said about this definitely being part of our future, it's definitely part of your future, and more than likely part of my future as well, that these things are going to become part of our regular financial life very quickly. We won't have, in fact, I don't think this was following blockchain technology, but I've signed, I did a housing transaction with never signing actual physical paper, did everything online. Blockchain just adds a level of security to it and a level of transparency that isn't available in other technology, I guess what I'll say. Hopefully that helps a little bit, Luke. Okay.
Absolutely.
Other comments or opinions, thoughts? All right. Well, let's doggone it. Again, bad slide deck. Let's get on to talking about these models. And the very first model that comes up is what's called the dividend discount model. And I'm going to fill this all in. The dividend discount model, also known as the Gordon growth model, has been widely used. The weakness is you got to have a company that pays a dividend. There are fewer and fewer companies every day that pay dividends. By the way, over the past 30 years, companies have shifted. Instead of giving money back to shareholders through a dividend payment, they've started to shift to giving money back to shareholders through repurchases. So there are a variety of types of repurchases that companies will do to give money back. There's open market repurchases, there are tender offer repurchases, things of that nature, even accelerated repurchases. But so one of the weaknesses of using this sort of model is you got to have one of those few companies still that pays dividends. Now, when we're talking about blue chip and S&P type 500 companies, Many of those are older line companies, and they'll still be paying a dividend. So this model is used and is useful in that case. In Sherwin-Williams' case, they do pay a dividend. Now, the residual income model is of similar form, and it allows us to value in a similar way companies that don't pay dividends. So don't worry, there are other models out there that we can use if you have a company that doesn't pay a dividend. Basically, all this says is that we've got these dividends, D1, that's next year's dividend, and these are always on an annual basis typically. So even if dividends are semi-annual or quarterly, we sum them up over the year. So next year's dividend is D1. The year after that in the future is D2, D3, and we run out. There's a certain limit to the value of going far out. But after you're out 10 or 15 years, that's anything beyond that, the discounted value of that becomes de minimis. So all we're doing is we're taking the next dividend and we're discounting it back to today at the cost of capital, which is represented by K. This is a risk-adjusted, and discount rate is another way to term that, but I also, you'll often hear it referred to as cost of capital. That comes out of the capital asset pricing model, CAPM short. And we're not going to get to CAPM until after the midterm. But for now, just recognize that CAPM is a pricing formula that helps us to determine the riskiness of a particular security, and in particular, the amount of that risk that is priced by the marketplace. In other words, the market will give you return for taking on a certain part of that risk. There's a total risk, there's a market risk, and then there's an idiosyncratic risk. We only get paid for market risk. But that cost of capital, that K, is the discount rate or cost of capital. Then P sub 0, of course, is the price at today. So we get the discounted value of the next dividend, the discounted value of the dividend after that. And note that we're discounting it for 2 periods, and then the following dividend for 3 periods, and so on, up to capital T periods. We add all those suckers up, and that is the price based upon the dividend discount model. Now, you might say, well, gee, where is the capital gains, right? Because isn't return composed of cap gains and dividends? Well, yeah, it is. However, isn't the capital gain that you receive at any given point in time just simply the amount of cash flows that you expect to get back in the future beyond that point? The answer again is yes. So we can show it. I'm not going to show it to you just because of time, but we can show that this actually does take into account cap gains. Or, on the other hand, we could end this thing, instead of ending it at T, we could add, well, what is the price of this thing that we expect to get at T, and discount that back T periods as well, if you're really worried about that cap gains. But then you get the problem of trying to figure out what that P sub cap T is. Here's an example, and here we're taking a $100 dividend for 3 years. We have a cost of capital of 15%, and we're discounting those 3 dividends at 15%. And we come up with a value of that series of cash flows of $228.32. So very much like what you saw in business finance, basic finance, when you're talking about discounting cash flows, a series of cash flows. When we want to think about this in terms of, and here I apologize, I thought I had my slide deck that was fixed up so that it would display on my iPad properly, and sure enough, I don't. So let me go to my computer and see what I can. All right. So I'm going to fix this animal up. All right. So I did fix this one. I don't know why I didn't pick up those other guys down there. All right. What we have here is that since dividends, we're assuming that dividends are going to grow at a constant rate. And again, this is not particularly in line with what actually happens in the real world, right? Has anybody looked at the dividend payments of a company? You will be very soon. Sherwin-Williams is in your future. Well, let me show you what the dividend payments for a company looks like. If this is time and this is your dividend, you're going to see dividends go like this. And there's only going to be a very small change. Sometimes that might happen on a yearly basis. I think Apple has taken to the pattern of increasing their dividend by about a penny every year. Other companies will go 2 or 3 years without increasing their dividend whatsoever. So you actually have this fairly constant flow of dividend payments over time. So the idea in this model that they grow at a constant rate is not really particularly realistic. And that can create some problems. Let me explain just briefly why this is the case. What happens, anybody know what happens when a company cuts its dividend or completely gets out of the dividend paying business?
Doesn't the stock price go way down?
It goes way down like a rock. Yes. The reason is it has to do with what the market is perceiving is behind this announcement. What the market is figuring, here's how market participants are looking at that. They're saying, hey, the only reason they're going to cut the dividend is if things are really much worse than we know. Because if they cut it just a little bit, we're going to assume the worst. So they're not going to cut it just a little bit. And so what they're going to do is they're going to try to wait it out and see if things don't get better. And we just really stretch it way out as long as we possibly can until the very last minute when we know we're going to have problems if we don't cut the dividend. And hey, guess what? The market goes, aha, we know where you are now. We understand. We thought the price was up here. You have just told us the price is actually down here. So companies try not to cut their dividends because it's a very bad signal. Remember, and now I also have to preface this by saying that we live in a world of what I call asymmetric information, meaning that we are differentially informed. The management of the company is much better informed about the financial state of the firm than you and I as investors are. And so there's always this conflict between management and investors. There's always a tension there. And I'm trying to guess what's really going on, and management's trying not to tell me. But if they cut the dividend, oh boy, there's a clear signal. So this whole area of signaling theory actually is quite interesting. There's a lot of signaling theory embedded in many of the financial models. We look at all kinds of signals. I don't listen to what the CEO says. I look at what the CEO does. What the CEO says is meaningless. What they actually do is much more meaningful. So as a signal, I might even look at whether the CEO is buying the stock or selling their stock in their personal portfolio. They have to report it. Shows up in Edgar. They have to report it within, I think it's now within 2 business days of doing the trades. Insider trading has to be reported fairly timely. So anyway, there's an assumption embedded in this model that isn't quite the real world. And that's why at the beginning of this chapter, I said, hey, these are kind of back of the envelope, quick and dirty estimates of value. And this in part is one of the reasons. All right. Now, if we wanted to, and let me see if I can get rid of, for some reason this thing is not letting me erase. Oh, no, I went to another slide. All right, so if we wanted to just value this thing for a specific number of years, we have a closed form solution here that's a little easier than running out a sum for 10 or 15 or 20 years. So that closed form solution is, I break it up into 2 elements. This d sub 0 times 1 plus g divided by k minus g. And that is also the constant perpetual growth model. I was trying to figure out what's going on. It looks like it's raining outside my window here. So this particular formulation, if I just wanted to assume that the company was going to grow or it's rather the company's dividend was going to grow at a constant rate of G forever, then I could actually just calculate this formula. And that's called, again, that's the constant perpetual version of the Gordon growth model or the dividend discount model. Now, if I want to limit the time period that that company is going to grow for, because forever seems like a long time, right? Then I could add this thing right over here that I know is getting a little messy, but let me write it out over here. The thing in the brackets is 1 minus this ratio of 1 plus the growth rate divided by 1 plus the discount rate raised to the teeth power. And that will limit my window. So basically by multiplying this animal by that animal, I can say, well, tell me what the value of the company is if I get that dividend from now out till the teeth period. All right, so 2 different versions of it. I'm going to skip over the, well, here's the constant perpetual growth version of the model that I just showed you. 1 minus G is equal to, there we go, where G is less than K. So here are 2 different ways of looking at it. This one right here, I'm using the current dividend, the one that just got paid, D sub 0. And here, I'm using the next dividend. The only difference is I grew it at the rate of G. That's my constant dividend growth rate is G. The other thing to keep in mind, and again, this is one of the assumptions that causes this really convenient back-of-the-envelope method to create some very strange numbers in certain circumstances. Think about what happens if G is greater than K here. Well, if I just do the math, P is less than 0. In other words, it has a negative price. Can't be, right? That's not the big problem because that's pretty obvious. If I get a negative out of this, I know I got a major problem. Now, it's not that G can't be greater than K for a for a certain or short period of time, but in this model, it can't be because of the way the model is formulated. But here's the more insidious problem. If K is close to G, but still slightly greater than G, what happens to my denominator here? You know, let's say I've got a K of, I don't know, 9% and a growth rate of, say, 8%. Then obviously 1 minus the other is 1% or 0.01. Whatever that dividend is, let's say it's $1. So I've got 1 over 0.01. That equals $100. So a dividend with a riskiness of equivalent to 9% K that's going to grow at 8% will yield a $100 value for me? What if I made them even closer together? Made it 0.001. Well, that would give me a value of $1,000. As these things approach each other, price goes up exponentially. So that's another one of the problems with this model, is that if K and G, even if K is greater than G, if they are relatively close to one another, I can get numbers that are quite a bit larger than they should be, just because of the formulation of this thing. I'm going to skip over this example. You can go back and look at it, but just for brevity, skip over it. So how do we calculate G? Variety of ways to do that. We could take the historical average. We could take a trend. We could take the industry average, or we could do this sustainable growth rate. All of those are perfectly well and fine. However, those are all of these are backward looking. You need something that is forward looking. And this is especially true in your security analysis. I'm going to ask you to come up with a growth rate. And you're going to probably start with one of these methods right here. But you can't stop there, because that's what's happened. What is going to happen, though, well, we don't know. Is it going to be the same? Your mileage may vary, right? You know, the disclaimer at the end of every security analysis things is, you know, we don't know if this is true. We're looking into the future. But what I want you to think about is what other factors might influence that growth rate, either up or down. That's what you're looking for. Is there particular reason to think that the competition will be more intense in the future or less intense? And how is that going to affect my ability to maintain my particular margin that I have, or to maintain my particular market position? If I'm a market leader, is there somebody coming up close to trying to overtake that position? So while these mechanical things are helpful, they get us a good bit of the distance, because let's face it, many companies are fairly stable. I would think a priori that a company like Sherwin-Williams, relatively stable. So last year's and the years before and the year before that growth rate, that's not a bad beginning point to think about what's going to happen next year and the year after that. But to really add value, to pay for my salary as an analyst, I need to go a step beyond that. And I need to look into the future and say, new product being developed by Sherwin-Williams. It's expected to have a patent that will last 20 years, and it's going to do away with the need for recoating iron. Instead of every 2 years, you can recoat every 4 years. It's going to save a tremendous amount of money. New technology. What's that worth? Is that going to cause the growth rate to go up? Yeah, I'd bet it would be. So I want to factor in those sorts of things. So it's very important that while you can use some of this as a beginning point and to get a sense of where the company has been, you as an analyst, you're looking at where it is going. not where it has been. So always look at those forward-looking things. And here again, I won't go through this example in any detail, but you can look at this in terms of how to figure out, we can get an arithmetic average, we could get a geometric average, we could even look at a trend over 2 years or over 5 years and see where it's heading. So those are the types of things that you can use to come up with some sort of starting point for a historical estimate, and then add or subtract to that those forward-looking elements. Sustainable growth rate is I did mention this in the discussion. Somebody asked about sustainable growth rate. And let me just get to that slide so I make sure I put in the right, I don't know why I thought for sure I'd fix these all, but obviously I had not. Guess that's all I really need to put in there. Okay, so sustainable growth rate says effectively, how fast can the company grow without any outside sources of financing in the form of either debt or equity? So the only way for that company to grow is what I would call organically or sustainably, and that is through the cash that they generate from their revenue. And whatever is left over after I pay out the dividends, that's retained earnings, right? That goes onto the balance sheet, from the income statement to the balance sheet. And now that's new capital that the company has generated organically, if you will, or sustainably. So that new capital is going to earn the same rate of return that the current capital earns, the ROE. So that's going to generate yet new capital above and beyond. And I can keep growing the firm that way. So this sustainable growth rate, again, is a good baseline estimate. It's not the spot that you want to stop, but it does give you some ideas. So what if the company didn't go out to the external market, didn't go out and raise additional funds? How fast could it grow based upon the amount of retained earnings that it has? That's simply the ROE times the retention rate, or ROE times 1 minus the payout rate. Obviously, 1 minus the payout rate is the retention rate. And of course, ROE is simply the return on equity, net income over the amount of equity. Another thing to keep in mind when you're, especially today in today's world, 30 years ago, this wasn't too big a deal, but when you're talking about retention rates, you not only have to consider dividends, but you need to think about repurchases, because repurchases are another cash outflow from the firm to the shareholders, just like a dividend. And so the payout ratio is higher than simply the dividend rate. So when you're looking at Sherwin-Williams, and I haven't dug into them, but I'm assuming they've done some repurchases recently. So, and I know for sure they pay a dividend. So that payout ratio is the sum of the two, not just the dividends. And again, here's an example. I'm just going to skip over it in terms of time. You can go back to the slides and pick that up. All right, so here's introduction to the ROE decomposition, aka the DuPont analysis. And again, as I mentioned earlier, we don't do a DuPont analysis just to do that. It's not an end in itself. It's kind of really a beginning point. It's an investigation. So here we've got net income, which is really an important factor for investors. ROE, return on equity, net income over equity. But what we can do is we can actually break that up into 3 or more parts. So you'll notice that when I multiply these 3 ratios together, sales cancels sales, assets cancels assets, and I'm left with net income over equity. So those 3 ratios multiplied by one another are indeed ROE. But the neat thing about this is that this helps me to determine what is driving the ROE. Is it because of leverage? So assets over equity. That's a measure of leverage. Now, I know, I'll grant you, it's not the typical measure of leverage that you and I might think of immediately. So if I asked you, how do you get leverage, or what's leverage? You'd probably say debt over assets, right? So how much is $1 worth of assets funded with debt? And let's say maybe it's 40%. So every dollar's worth of assets, 40 cents of that is funded with debt, 60 cents with equity. But assets over equity is also a way of measuring leverage. Here, and again, this is true of all these ratios. When you think about, good bit of wind coming by here. I got a squall. I don't know how many of you are near Shaker Heights or University Heights. Yeah, it's getting pretty ugly out there. I haven't looked at the radar, so hopefully I don't lose power. We'll see. My backup generator is probably not going to kick in soon enough. All right, back to this. So this is some measure of leverage, but what is it really telling us? Well, what we're going to get is something like, let's say we get 2 out of that. So in other words, there's always this implicit 1 in the denominator. It's not, we don't ever write it that way, but I think sometimes it's worth putting that 1 down there. So what does a asset to equity ratio of 2 tell us? Well, what it tells us is that $1 worth of equity supports $2 worth of assets, right? Even though we never usually write that, we just write 2. That ratio is 2, meaning that the rest of it is funded by debt. So that would be equivalent to a debt to asset ratio of 0.5, right? So the higher this thing is, the greater the leverage we have. This middle ratio, sales over assets, gives us, again, think of it as sales over assets, and let's say that that is 5. So what that's telling us is that for every dollar's worth of assets over the year, we're able to generate $5 worth of sales. Now, is that good or bad? I don't know off the top of my head, because I don't know what other companies in that same business do. And maybe 10 is good and 5 is pretty bad, or maybe 5 is good and the average is 3. That's why I have to look at the comparables, my other paint companies, in order to tell. But that's what I'm really getting after. I'm trying to figure out, what is it that Sherwin-Williams does extraordinarily well? Is their ROE driven by the amount of debt that they have on their balance sheet? Or is it driven by their very efficient use of assets? And if 5 is the average, and maybe Sherwin-Williams has a sales to asset ratio of 7. So for every dollar worth of assets, they generate $7 worth of sales. Maybe that's what's driving their higher ROE. And then this final ratio, net income to sales, gives us some idea of the margin, the profitability. So for each dollar worth of sales, how much of that, as we trickle through the income statement, ends up being net income? So that number might be, I don't know, it could be 0.1. So for every dollar we generate in revenue, we end up with 10 cents of profit at the end of the day. And again, is that good or bad? I don't know. I have to look at the comparables. I have to see how the other paint companies are doing. Maybe they're really lower than that, and Sherwin-Williams is doing well, or vice versa. But this decomposition, I think, is really key to starting to understand a company. You can't understand what's going on in a company simply by looking at ROE. You can tell, again, compared to its comparables, is it doing well or not? But you don't know why it's doing well. Is it because of margin? Is it because of efficiency? Is it because of leverage? All right. Questions about DuPont? All right. Then we can move to a two-stage dividend discount model. And again, got that same pesky problem with my formulas. This one is a bit uglier.
Would these formulas be given to us on our test?
Yep, absolutely. Absolutely. Yeah, I don't expect you to remember them. I don't remember them. Why should I expect it? Yeah, I mean, they're available in a textbook. If you're working, you're going to find them. The key that I want you to bring to the table here is how to use them and what their weaknesses are and where they're going to let you down. So that's going to be your value add. So here is the two-stage dividend discount model. Now, this is a little more realistic than the one-stage constant perpetual version of it. And here's what's going on here, really, in a nutshell. We can break this up into two components. So here is our first stage. And here is our second stage. So notice that this guy right here looks a lot like that constant perpetual growth version of the dividend discount model. And in fact, it is. And it's using G1 as the growth rate. So that's my first period of growth. So effectively, what that formula is saying, that part of the formula is, what would this thing be worth if it grew at G1 forever? Then, what I'm doing with this thing in the brackets is I'm saying, well, you know what? It's not going to grow forever. It's only going to grow for T years at that rate. So I'm going to, let's say we're here at time 0, and we're going on out here to infinity. So, and here is T. So while this first bit right here runs from here on out to forever, this little bit says, hey, subtract off this piece of that value. So we'll be left just with this piece right here. So that's that first stage. That says, what's the company worth with a growth rate of G1 for T years? And then this second stage down here takes the rest of that. So it's going from T out to here. And again, you'll notice that this piece of it is also the constant perpetual growth dividend discount model, but this ratio right here just says, well, just do it for these last T years. Or sorry, do it from year T out to infinity. So while this formula looks a little bit complicated, it's not nearly as complicated as it might appear at first blush if you break it down into these two components. Now, doing the math can be a real pain in the neck on your calculator. You'll get some practice at doing this in your homework problems. Can you expect to see a question with the two-stage dividend discount model on the midterm? Yeah, without doubt. It'll probably be the worst calculation on the whole midterm, but just break it up into these pieces. It's definitely not undoable. And it certainly beats the heck out of doing an infinite series, just by itself, without a closed form solution. Let's see. Again, an example here. I'm just going to skip through that. And like this, also supernormal growth. Oh, let me talk. Let me talk a little bit about where we might want to use a two-stage dividend discount model. That's important. Would Sherwin-Williams, on the surface of it, be a company that we might want to use a two-stage dividend discount model on? I'd say, without knowing much about what Sherwin-Williams is doing right now, the company's been around a while, right? Probably not a good candidate for a two-stage model. The reason that I would say that is that you want to use a two-stage model for typically younger companies, more of a startup firm, where they have a very high growth rate early on. But obviously, that growth rate cannot sustain forever, or the company would grow to be bigger than the economy as a whole, especially under the assumptions of this model, which is I'm doing this till forever. And so this model is much more appropriate for a tech company, some sort of early stage company in general. Now, having said that, that doesn't mean that Sherwin-Williams might not have a growth spurt coming up. Maybe they've got a merger in the wings, and that's going to cause them to grow at a very high rate for the next 2 or 3 or 4 years, but then revert back down. So I'm not saying you can't use it for a company like Sherwin-Williams, an older line, more mature firm in a more mature industry, but it's less typical that you would use it for a company like Sherwin-Williams. And again, in the interest of time here, because we have just barely scratched the surface. We haven't even talked about residual income model or free cash flow or the relative valuation methods. That's going to have to wait till Thursday. And but this H model right here, I'll just give you the brief overview of this. What the H model does is that it says in the two-stage that we looked at right back here, we had a hard cut at time t. So in other words, we said that, let's say that G1 was much higher, and then all of a sudden at time t, the rate drops to G2, and it goes on out to forever. The H model says, well, wait, hold on. That's not very realistic. What usually happens is that we might start off at a value of like G1 here, and that would go on for a period of time, but then it would slowly decline, and then we'd arrive at G2. So the H model says, let's make this a little more realistic model, which is all well and fine. So if you've got a situation like that, then the H model is a more appropriate method to use. And then here's graphically, this is what they're arguing, is that we've got this gradual shift from G1 down to G2. All right, so how do we calculate that K? Well, without having the knowledge that we're going to get after the midterm, which is where we're going to start talking about the capital asset pricing model, we still need to have some basic sense of how to calculate K. And this formula right here is it. This is what's called actually the market model. But that market model comes out of this theory that we call the capital asset pricing model, or CAPM for short. So it's very simple. We're going to simply put together the time value of money, which we're going to proxy for with the US T-bill rate, except when we live in days like we live in today, where the US T-bill rate is very, 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 very close to zero. And remember, we're projecting out for decades into the future. So we can't assume that that T-bill rate is going to remain at 0. So a more reasonable rate, if you want to capture any sort of market component to it, is to either use a longer term instrument like a 5-year note, 10-year note, or to take some sort of historical average of T-bills over the last quarter century. Then you're going to get a T-bill rate that might be closer to, say, 3-ish%. And then the other piece of this is the amount that you get for taking on risk. This first piece, this T-bill rate or the risk-free rate, is what you get for just delaying use of your money. And the second component is what you get for taking on risk. And that risk is measured by what I'm sure many of you already know is beta, the famous beta. Beta has died over various periods of time, and it has reappeared even stronger. So the theory has gone out of fashion in that many people thought, no, this theory just doesn't describe the real world. But then we got more evidence, and we said, well, wait a minute, I guess it actually does, but let's add a couple of additional factors to it. But the first one, the CAP-M, developed back in the late 50s, early 60s, is where we get this idea of beta. That first beta is simply the amount of risk that a particular stock brings to an already diversified portfolio. And we're going to take that beta and we're going to multiply it by the market risk premium. So the market risk premium is the return on the market minus the risk-free rate. Oops, you can't see that. All right. So it's not the entire return on the market. It's the return on the market minus the riskless rate of return. So it's that market risk premium. That's why it's called the MRP, the market risk premium, times the beta. Anybody know what the beta on the market is? Go ahead, Matthew. Oh, you're muted. Oh, there you go.
Isn't that kind of like how volatile it is compared to the market? So if the market like is close to 1, so if the market were to go like change a lot, if it was, I forget if it's farther or closer to 1, then it
No, you've got it exactly. The market is actually by definition is 1. So if we have a stock whose beta is 2, as Matthew was saying, it's twice as volatile. The price is going up and down. So if the market is up 5%, that stock typically, now on any given outcome, it's going to vary, but if the market is up 5%, that stock will be up 10% on average. Now, we could have a stock that has a beta less than the market, so it could be 0.5. And that stock is only half as volatile as the marketplace. So we calculate this beta for a particular stock. And whatever that beta is, so let me rewrite this formula. K is equal to the risk-free rate plus beta times, the market risk premium, which is the return on the market minus the risk-free. So that, in algebraic terms, is the market model that comes out of the capital asset pricing model. So that's how you get your K. Pretty simple. The trickier part, and you're going to find this because this also is going to be part of your security analysis project, I'm going to ask you all, each team, to calculate your own beta. Now, beta is widely available on Bloomberg or Yahoo Finance or Zacks or any other number of financial data sites. But what you're going to find is that that number varies from site to site because it's dependent upon how the person calculates beta. I could use a 5-year window and I could use daily prices. That would give me somewhere near 1,200 and it's going to give me 1,262 observations. A lot of observations. And 5 years is a good span. Frequency is quite frequent. But if somebody else uses that same 5-year span, but a less frequent interval of, let's say, quarters, so 12, I was thinking months, 4 quarters a year, 5 years, they only have 20 observations. Running a regression with only 20 observations is fraught with problems. So why don't I come to a middle ground? Let me use monthly or weekly. So monthly, I have 12 months in every year, so I'd have 60 observations. Well, that's enough to run a regression with some reasonable expectation that I'm going to get a beta, a slope coefficient that's reasonable out of it. I could also do weekly, so 52 weeks out of every year. So that's going to give me over 250 observations, and that's also acceptable. But it's up to each analyst. And maybe I didn't do 5 years, maybe I only did 4, or maybe I did 3, or maybe I do 10. So each site, whoever it is, Bloomberg or Yahoo Finance or Zacks, they're going to use a different span, and they may use a different frequency. It's also up to you to choose that span and frequency. And I would argue that in the case of Sherwin-Williams, I would be, and this is true of any company, I would be careful about picking too long of a span. And the reason is that the further back I go, the more likely that the company today was a different company back here. And what I'm concerned about is the riskiness of its assets and its leverage. Because if either of those things or both of those things change, that's going to affect its beta. And it's not going to be representative of its beta today. So here again, we've got these models. We've got a direction to go. We've got some very solid theory behind it that's been tested and wrung out for decades and decades. But even implementing it can be difficult and challenging. And that's why we need analysts. That's why we need folks like yourselves who understand this and at least have some sense of the weaknesses embedded in these models and take that into account when you make your analysis. So when you're working on coming up with your beta estimate for Sherwin-Williams, pay attention to what's happened to Sherwin-Williams over the last 5 to 10 years so that you have some idea of what sort of span do I want to use to estimate my beta. Now here's one other problem. If I use too short a span, I don't capture market variations. I don't capture a boom market and a decline, and then coming back into the economy coming back. So what I'd ideally like to do is to at least capture one full cycle in the market and still make sure that the company I'm using is still more or less the same company. It still has more or less the same riskiness embedded in its asset base. Those are the things that analysts should be losing sleep over. Am I doing this properly? One other thing that I'll mention here, and I'm not going to ask you all to do this in this project. It's complicated enough as it is, especially since none of you have ever done anything like this. Is anybody already an analyst? Actually, there's some chance of that, but I don't think anybody said that. So the other thing that's out there that, again, your text doesn't talk about, but has been developing over the last at least quarter century, actually it goes back even more than that, it goes back 30 plus years, 40 years, is multi-factor models. And probably the most famous is the Fama French three-factor. So what Fama and French did, Jean Fama and Ken French, Jean Fama of University of Chicago, Ken French at Dartmouth, I believe, back in the, I want to say late 80s, they came up with this idea that, hey, you know, CAPM is missing a couple of really important elements. There's this size effect. So bigger companies tend to have lower returns than small companies. And we also noticed in the data that there is what's called a book-to-market effect, or a market-to-book. You could use the inverse of it. But what that is any of you familiar with value companies versus growth companies? Have you heard of those two terms? A value company is a company that has a very low market-to-book. In other words, the book value of equity, let's say it's $1. What's the market value that at? Well, maybe the market values it at about $5. So that's a relatively low valuation for that. Oh, sorry, let me take that. I take that back. Let's say the market values it at about $2. It's a relatively low valuation for the book value of assets, for $1 worth of assets on the books. Another company, you got $1 worth of assets, and the market might value it at $4. It's twice as valuable. So the higher that market to book is, the more there's a embedded expectation of high growth in the future. So those are more of your growth companies, and the other companies are more of your value companies. You can look at PE as well and get the same sort of measure. But Fama and French, as well as numerous other researchers prior to them, had shown in the data that those two factors really seem to influence returns. So why don't we add two more factors to the capital asset pricing model? And this one we'll call the Fama French three-factor model, because it includes beta, this beta right here, the one that we all know and love, but it also includes the size effect, and it includes this market-to-book effect as well. And so that's been going on for the past 30 plus years. We're actually up to 5 factors in some models. We've got others that are 6 factors. I don't think anybody's gone to 7 yet. I wouldn't be surprised in the next few years somebody comes up with a 7th factor, though. The point here is that beta is not the end-all be-all. And in fact, if you're just using beta and you're not capturing the size effect and the market-to-book effect, you're probably missing a lot. The other thing that you're going to find when you actually calculate these figures on your own is that the R squared, and remember the R squared in a regression, because to calculate this beta, we're going to run a regression. You're going to regress the returns, the excess returns of the security on the excess returns of the market, and you're going to get a slope out of that. That coefficient is your beta. The R squared tells you how much of the market returns describe and capture the variation in the individual stock returns. What you're typically going to find is that R squared is very small, which also means that there's a whole lot of variation in the individual stock returns that's not being captured by the market returns, by the variation in the market returns. And so that too leads us to think about, hey, maybe we need multi-factor models. Maybe we need, at the minimum, the Fama French three-factor model to actually capture this well. I don't know to what degree analysts are using a three-factor model. I would pretty well assume, since it's been around 30 plus years, that most analysts are probably calculating a three-factor model, or at least they should be if they're not. Some of them may even be calculating 5- and 6-factor models to estimate their cost of capital, because I'm looking for a much better estimate of K. The more accurate an estimate of K that I can get, the less I have to worry about K not being correct for my particular company. And then I can worry about the growth rate instead, because that's also measured with error. Remember, many of these things that we're, especially when we're looking into the future, these things are measured with error. And to the extent that I can minimize that error, or at least reduce it to some degree, I'm better off. So just a word to the wise. And like I said, I'm not going to have you do this in the security analysis. I'm not expecting you to understand anything more than just knowing the word Fama French three-factor model. But know that it's out there. So when you go into the or back into the real world, you'll have some sense of what people are talking about. Let's see, where are we time-wise? 9:07. This just talks. I've already gone through most of these. That when G's greater than K or they're close together, they're very sensitive. The constant perpetual growth is unrealistic in many cases. Two-stage helps to reduce some of those problems. It even lets you have a G greater than K in the first stage. However, it's still not usable in stocks that don't pay dividends. K and G are difficult to estimate and so forth. One last thing to think about is in any situation, we never want to give our boss or our professor a point estimate of value. We always want to give them a range. A point estimate is almost always going to be wrong. A range, at least we stand a better chance of the real thing falling within that range. So this link here is to a little video that helps describe and hopefully will help you to understand what a Monte Carlo simulation is if you don't already know. In short, Monte Carlo simulations are used to estimate the sensitivity of a particular variable as an input. So what I'm going to do is I'm going to run that model, that valuation model, whether it's the constant perpetual growth or a two-stage, and I'm going to take all of the variables that I estimate with error, the G, the K in particular, and I'm going to what we call parameterize them, which is I'm going to put a distribution on those things. I know what the mean is. I just calculated the mean of K is 9% and the mean of G is 6%. But I'm also going to make an assumption that maybe these things are normally distributed and have a standard deviation of 1% each. And then I'm going to plug it into this spreadsheet add-on. There's several of them. Crystal Ball at Risk is another one. And what it's going to do is it's going to draw out of each of those distributions for K and G, plug them into the model, calculate a value, save that value, and then do that 10,000 more times. And it's going to take all 10,000 values that it's estimated, and it's going to put them into a histogram. And it's going to display that histogram for us, and it's going to say, hey, there's a 95% chance that your value is between this point and this point. That's where we really want to be when it comes to sensitivity analysis. But click on that video, take a look at it. It gives you a little more in-depth idea of what a Monte Carlo simulation is. I think this is a good stopping point. It's 9:09. We can start on the residual income model first thing on Thursday. Any questions before we wrap things up, though? We've got a few more minutes. I don't see anybody saying so. So I know, who was it who wanted to stick around? April, you had a question, and Brandon as well. Okay. The rest of you, I will see you on Thursday, 6:30.